Welcome everyone to our solar electric investment analysis web seminar series. This is the fifth session of that series. We have one more coming up on Thursday, and this particular web seminar series is sponsored by the North Central Region SARE, and we are doing some work to try to educate NRCS, USDA Rural Development Extension, also rural bankers and others on solar investment analysis in particular, so they can help their own clients and teach their own clients related to this. We're hoping that this information is useful and it improves your ability to maybe do an analysis yourself, which would be ideal. But even if it doesn't, to get to the point where you're having better conversations, being able to read a installer's quote clearly, compare it to others. So these are some of the things that we'd like you to be able to do after you get done. Today's session is going to be on conducting a financial analysis, and in particular we're talking now about the financial metrics and should be some of the financial metrics that you should pay the most attention to, and which ones maybe aren't so good. And the reality is that we've never really come up with that one particular metric is the one that everyone likes the best or that is the best. It's kind of a mix that people want. One thing we hear a lot is payback, so we'll talk about that quite a bit today. But sometimes payback, as we've already kind of seen before, but we'll see more today, may or may not be the best metric to look at from a financial standpoint. We're also going to cover a little bit today, some on utility scale solar leasing. Part of that is that we know that farmers and landowners in our areas are being contacted very regularly to sign contracts to lease land for solar. So we want to get into some of the issues related to that, just as an overview and some additional information for you to help kind of very timely topic. Also on Thursday, I'll kind of give an introduction for that, so I don't have to do that at the end here. We're going to be actually going through the system advisor model and modeling some demonstration systems, and that'll be an excellent one for you to be at, to learn how to run the system advisor model yourself, and some of the power of that model and how easy and challenging it is to run and get good numbers from it. It can be easy, but also it can be a little tricky if you don't spend some time with it. So we'll be going over some examples on Thursday. So with that, ask your questions in the chat box. I will be monitoring the chat box. You can ask them anytime and we'll get to those questions. At the end, if you want to speak up and ask your questions, we'll have time for that as well. And I'll turn it over to Eric Romick for today's presentation.
Great, thanks, John. So yeah, as John mentioned, today we're going to be talking about conducting a financial analysis and specifically looking at what are some of the key financial metrics that we commonly see in proposals that are shared with farmers. How are they calculated, and what are they telling us? So we want to try and better understand what these metrics mean. So we're going to start out by looking at some common challenges with PV solar proposals, understand the benefits and challenges of these financial metrics, and then as we start to wrap up, once again, I'll share the link with where you can download the system advisor model and encourage you to do that in preparation for Thursday's session number 6, where we'll be, as John just mentioned, doing some different, building some simulation models and doing some different analysis. So we're going to start by looking at what are some key challenges and considerations when we're evaluating PV solar project, that a proposal that may be presented to a farmer. And this is an example, and I feel like sometimes, as John and I get down into the weeds of some of the different variables that can influence a proposal, and whether a project is one that may have good metrics, or one that you might look at and say, that's probably not a good investment. So a lot of times I feel like, we're not dramatizing this. This is based on these issues are based on proposals that are being presented and shared with farmers all the time, throughout the Midwest. And so here's an example. This farmer had received a 50 kilowatt rooftop proposal, and he said, this is going to pay back in less than 3 years and provide $360,000 in energy savings over the life of the project. What do you think? And if you kind of zoom in there, and this is just one page of a proposal that was, it was very well done. I mean, it was well marketed. It was probably a 10-page proposal that had a number of different charts and graphs and details in there. But here's kind of the summary sheet. And if we think back to session number 2, when we talked about cost and kind of that step 1, if we just look at the initial system price down here, and John, can you give me a thumbs up? Can you see my cursor? Okay, good. That initial system price of $212,500. If we break that down on a installed cost per DC watt, we're at $4.25 per DC watt. And remember, we were looking at some of those price trends in session number 2, and we talked about how $1.83 per DC watt was the national average in 2018. So right off the bat, we know we're a little bit high. The other thing we talked about was looking at the price gap. So what's the gap between this gross system cost, or the number we're writing on the check, and then what they're actually promoting up here as the net system cost? And remember, we talked about the larger that gap, the more aggressive some of the assumptions might be in the financials. And that gap, if you do the maths, I think $193,500. So right off the bat, there's a couple things of concern. So as we look at this a little bit closer, then we can see how are they getting from 212,000 down to 19. The initial system price, they're actually knocking off 12,500 for kind of a customized, what they referred to as a SREC, or a solar renewable energy credit rebate. Then at that point, they're applying a REAP grant that they're saying is probable. We discussed how in many states that's a very competitive program, outstanding program, yet again, state by state, it kind of depends. But here in Ohio, it's a fairly competitive program. So, and then also this always kind of is interesting when they want to charge $1,000 or $1,500 for the application fee. I think that the USDA REAP grant program has done a really good job of simplifying that application process. And if you have an installer that's trying to charge you thousands of dollars to do the paperwork, I would suggest you get another quote, because there's others that are doing that at no cost. So another thing that's kind of interesting is our investment tax credit down here. This is actually a program that is not a real good fit for this. The Invest Ohio program was one that provided personal income tax credits to investors that were putting new cash equity into Ohio small businesses as part of an ownership stake. So it's not really a program intended for solar. And then, of course, as we look at, they're doing some of the math up top here. Once we get down to this net system cost, which again we talked about in session 2, this isn't the number we want to focus on. But then up top here, you see we're assuming 11 cents per kilowatt hour for every unit of energy we generate. John talked in session 3 about how that most likely is not the case. There may be some instances where you're getting the full retail rate if you're offsetting, but in many cases, if there's net excess generation, you're not going to receive the full value of that. And then the other thing that's kind of interesting as you look at their total energy savings is they put it right on here, 10% rate escalation for 10 years. So in my opinion, that's a little bit aggressive. So nonetheless, I just wanted to kind of share, there's a reason that we need to look at multiple metrics. These types of proposals are being shared with farmers all the time. And, if you're just to focus on this simple payback calculation in terms of years, you might look at that and say, yeah, this looks like a good project. One of the things we're going to look at today is how do we use a couple of other metrics to maybe serve as a system of checks and balances. So why is this type of a project difficult to evaluate? We keep asking ourselves that, and I think you can really kind of boil it down to summarizing it as there's complex and ongoing cash flows. And when you think about, what do we mean by that? The solar production is variable. It's based on when the sun's shining, right? And we can estimate that within reason, but obviously it's going to change year to year. Think about degradation, as we talked about in session 1. Your panels are going to degrade a certain amount over time. Operations and maintenance costs are going to be ongoing and variable and many times difficult to predict. Inconsistent revenue streams, as you think about tax credits, REAP grants, solar renewable energy credits, which again are tied back to production, the depreciation of the system, and energy savings. When we think about variable rate structures and pricing models, some may have volume-based benchmarks that have different pricing for how many kilowatt hours you're purchasing. Some have time of use, some have demand rates. Everyone's net metering agreements seem to be a little bit different in terms of, are you compensated for the full retail rate for net excess generation? Are you compensated at avoided cost rate? Those are all things that we discussed in session number 3. But again, when you kind of put all these things together, it makes it difficult to really analyze these projects. And you can kind of summarize it into 2 big categories. And that is, one, these complex and ongoing cash flows occur over a long analysis period. So when we think about solar projects, we're thinking about inverters that are often warranted now for 10 to 15 years. We're talking about solar panels that are carrying both product and performance warranties that could range 25 to 30 years. And then, of course, the time value of money that's associated with that long analysis period. So I want to take a couple of slides to kind of build the foundation of time value of money before we jump into a couple of these metrics, because I think it'll really help us wrap our arms around what we're saying. And again, my purpose here is not to make all of us financial consultants that can run around doing all kinds of financial modeling and evaluation for people, as much as it is to help you understand how is the system advisor model calculating these financial metrics and what are they telling us. So again, we're going to spend a couple slides to look at time value of money. We're going to start out by looking at what inflation is, using the story of a hamburger to help us understand that. So I guess in this case, it's a cheeseburger. But when we think about inflation, inflation is the general level of the increase in prices for goods or services over time that consequently will decrease the purchasing power of your currency. So let's think about that once as we think about this cheeseburger. It'll help illustrate that. So here's a receipt from 1998 where we had a quarter pounder, 2 large fries, and a chocolate shake. And in 1998, that cost $6.97. Now, if we look at that same order at McDonald's in 2017 from our receipt here, you can see a quarter pounder with cheese, 2 large fries, a chocolate shake. That's $16.26. So again, when we think of inflation, it's the general increase in the price of goods or services over time that is, in a sense, decreasing the purchasing power of your dollar. So think of that in terms of, if you walk into McDonald's in 1998 with a $5 bill in your hand, you could purchase 2 large fries and walk out. If you walk into a McDonald's in 2017 with a $5 bill in your hand, you're going to need to find $1.38 before you can purchase your 2 fries. So it's lessened the purchasing power of that currency. This is a chart that's kind of charting the U.S. inflation percentage changes over time between 1999 and 2019. As you see in the header there, this is looking at all items, and they're not seasonally adjusted. Now, if you go to the U.S. Bureau of Labor Statistics, you can look at the consumer price index for specific sectors. But what we're looking at here is all items, and the average percentage change from 1999 to 2019 was 2.19%. And I think about the inflation rate that we use in a lot of our modeling is typically 2.5%, and so this is kind of an indication why. And you can see there's some years where, obviously it's higher. We were north of 5% there and at one point, and then of course we also go lower. And you think about how trend lines can tell a story, and I think anyone could type into the chat box what was happening in 2008, 2009, right? We were dealing with housing crisis and subprime mortgages and automotive bailouts, and so things were difficult. But nonetheless, average of 2.19%. So shifting gears a little bit from inflation, we're going to now talk about kind of the time value of money, and I'm going to put up a poll question. So this group, let me just launch the poll quick. All right, so we live in this fictitious world where our solar workshop had a cash giveaway, and you all just had the winning ticket for $100,000 cash prize. And the question I have is, when do you want to receive your money? You can take this this stack of fictitious monopoly money today, or we'll give it to you in 5 years. So think about that for a second. When would you want your money if you won this $100,000 scratch off? We'll just give it a couple more seconds and go ahead and close. All right, so I'm going to go ahead and end the poll. And 100% of you have indicated that you would like your money today. And so, that's probably because you're interested in at least if you're in Ohio today, it's cold and windy and overcast. You're going to take that 100,000 and you're going to go to the beach and have a good time, or hop on a yacht and take a cruise down in the Caribbean. But actually, that's not the reason. The reason is you all went to your finance class in college and understand that if you had that $100,000 today, you could invest that and earn, say, 4, 5, 6% annually, and over the next 5 years, you could turn that $100,000 into something greater than that. So, 125, 126,000, depending on what your rate of return was, right? But the point is, that cash in hand is money that you can put to work for you, investing to create a return. So in summary there, as we talk about that, the time value of money concept is one that money available at the present time is worth more due to its potential earning capacity. So I want you to take that same concept and flip it upside down. So just as we can multiply the present value of $1 based on its potential annual rate of return on an investment to calculate the future value of that, we can kind of conversely do the opposite. So we could take a future dollar amount, if we know we have a dollar amount in year 10 or 15 of our cash flow, we can apply a discount rate to that to kind of discount it back to present dollars. And we have a couple tables that we'll share with you as we move through that I think will help you visualize this. But one of the takeaways is that consistency is absolutely key. And then the final thing that we're going to kind of talk about before we jump into some of the examples here is the discount rate. And the one thing that I like to point out with the discount rate is determining the proper discount rate is it's an inexact science, right? A discount rate can mean different things to different people. A discount rate could be represented as the cost of capital. It could be the rate of return that you would need to gain support or investment from a partner on a project, or it may simply be the rate of return that you could have in an alternative investment. So, but say you have $100,000 to invest, and your question is, should I invest that in solar or should I invest it elsewhere? So you could determine your discount rate based on that question. When you see discount rates, there's a real discount rate and a nominal discount rate. The real discount rate is simply the rate of return that you're going to determine for the project. The nominal discount rate is going to add inflation to that. So it's simply your real discount rate plus inflation will equal your nominal discount rate. Okay, so we're going to kind of transition now that we have a little bit of background, we're going to look at a couple of different metrics. And we took a peek at this table last Thursday in session number 4. But we're going to kind of dive into these metrics a little bit more before we analyze the results. We're going to spend a few slides on each of these financial metrics, which are these are all metrics that are calculated. So when you build a model in the System Advisor model, which again, we're going to spend all of session 6 on Thursday doing modeling, constructing a model and running simulations. When you run a simulation, it's going to give you a number of different financial metrics, and these are 4 that I like the best that we're going to look at a little bit to see how they're calculated and what they're telling us. But we're going to look at levelized cost of electricity, net present value, and then we're going to look at both the simple and discounted payback periods. So we're going to start with simple payback period because it's one that I see most commonly as I'm reviewing proposals that have been shared with farmers. And one second, we have someone just join us. Okay. So we're going to start with the simple payback period. And the payback period is basically the time in years that it takes for the cumulative annual savings to equal the cumulative annual cost. And we have you can see the formula there on your screen. So you kind of have your initial system cost divided by your annual production times the value of that production minus annual operations and maintenance. So you can see a number of limitations just in the formula itself as we think about productions, obviously, as we mentioned, going to vary from year to year. The value of that unit of energy could vary from minute to minute, depending on is there net excess generation? Are we using that? And then of course operations and maintenance we talked about can certainly fluctuate over time. So there's a couple limitations with this just looking at the formula. I want to share a screenshot. Here's a picture or a snapshot from a proposal that a farmer was considering. And there's a couple things that we notice as we look at this. Number one, I can see right off the bat that I can kind of run the numbers. We're using about a 2.5% energy escalation rate, where as you can see, the value of energy savings is steadily increasing over time. And based on what John shared with us on the first session, we should understand that if anything, we should expect our production to actually degrade or go down a little bit over time. So there's an assumption that the value of this unit of energy is increasing over time. The other thing that you'll notice is missing is any type of operations and maintenance cost. So when we think about ongoing cost, O&M or insurance, those types of costs are not included here. And what they're estimating is about a 3.5-year payback on this specific project. So again, a couple of limitations, and I guess my point in sharing this is you can call this a simple payback calculation, but it can be calculated a number of different ways, I think is the important takeaway. So calculating this simple payback, if you were to take all of the numbers into account and account for operations and maintenance and some of those ongoing costs, I would suggest that you probably have a little bit different payback period than what they see here. One thing to note, in the System Advisor model, SAM actually uses the after-tax cash flow, the annual after-tax cash flow to calculate their simple payback calculation. And what that means is it accounts for it accounts for all of the fluctuations as you think about operations and maintenance, as you think about incentives, other operating costs, income taxes, depreciation, debt-related costs, all of these things that take place in the cash flow table, because Sam is looking at the after-tax cash flow annually. That's all accounted for in the payback period that Sam will provide for you. So as we look at simple payback and just kind of a quick summary, strengths and weaknesses, there is value in simple payback in that it's easy to calculate and it's fairly easy to understand. I think most of us can kind of, we like to gravitate towards hey, how many years before I break even? And that's really, I think, what this is trying to provide for you. A couple weaknesses: it overlooks the time value of money. Depending on how you calculated it, it may overlook variable and ongoing cash flows. It doesn't ask the question what happens after we reach that payback period, and it's just it's one that can't necessarily rank this versus alternative investment options. So now we're going to look at levelized cost of electricity, or LCOE. The levelized cost of electricity is representing the per kilowatt hour cost of building and operating a power plant over an assumed life cycle. And to kind of focus on how it's calculated right here, the levelized cost of energy is equal to the total life cycle cost divided by the total lifetime energy production. So one of the things I want to point out with that formula is you'll notice it has nothing to do with electricity rates or the revenue generated from this project. It's specifically looking at the cost side. So one of the challenges that we've highlighted with these projects is it's difficult to accurately assign a value of energy to a unit that of energy that you're generating based on your rate tariffs and how you're charged for electricity, based on how your net metering rules are designed and how you're compensated for net excess generation. And so levelized cost of electricity it's a metric that doesn't necessarily use that in its calculation. So I kind of like this as a system of checks and balances to compare with, both the payback period and net present value, which we'll look at in a second. So when we think about it in its simplest form, the levelized cost of electricity is a measure of the cost of installing and operating that system over time, not the value of the electricity that it's avoiding you to purchase. The other thing that this will do is it's a good way to rank one project versus the other. So if you have 3 different proposals from 3 different installers, and looking at that levelized cost of electricity should help you determine, because it's based on cost, who's the most competitive in terms of the cost for the overall project per unit of energy. Some of the benefits and challenges of levelized cost of electricity. As we look at strengths, it combines the fixed cost, variable cost into a measure that I think we can all kind of easily understand. I think most of us are familiar, with kilowatt hours and thinking of, okay, well, we pay 9 cents, 10 cents, 11 cents per kilowatt hour. It's one that is easy to understand. So, essentially when you look at a levelized cost of energy metric, is it higher or lower than what you're currently paying for electricity from your utility provider? One of the things that was a bullet point in the previous slide, but I don't know that I necessarily talked about, is to kind of be cautious with the levelized cost of energy. We're not necessarily suggesting that you could use this to compare a net metered solar project with the cost of electricity that you're purchasing from your utility provider, because it's apples and oranges. You're talking about a project that is interconnected and using utility grid power as your backup when the sun's not shining, right? So it's what we would call a non-dispatchable technology. So there's a certain level of value in being able to provide electricity when you want it, not necessarily being dependent on when the sun is or is not shining. So it can be used to kind of rank solar project to solar project, but we're not necessarily suggesting that if you have a 5.5 cents per kilowatt hour levelized cost of electricity for your solar project, that's suggesting you should disconnect to the grid because it's cheaper. To make that comparison, you would need to kind of go all in and design battery storage and all of those components into your system to have an apples to apples comparison. Okay, so moving on, we're going to kind of start looking now at net present value. Net present value is probably my favorite metric to look at. I feel like it tells us the most and accounts for most of the variables that these projects present us with. As you think about the net present value, it clearly accounts for the time value of money and simulating the impacts of both inflation. So again, think back to our cheeseburger example. It's the inflation being the increased cost of goods that will essentially have a negative effect on our purchasing power, a dwindling effect of the purchasing power of our dollar. And then it's also going to account for, with the time value of money calculation, it will also account for the potential earning capacity of having cash in hand. As the bullet point here. So money now is more valuable than money later. So when we think about net present value, we're applying a discount rate to future cash flows. Again, we had a slide that discussed this, but I want to restate it. Choosing the proper discount rate is critically important to doing an accurate analysis using net present value. The discount rate can really impact the results of that metric. And when we think about what it's measuring, so after we apply the discount rate, we discount our cash flows, essentially net present value is fairly simple. I mean, it's measuring how much money the system will generate or possibly not generate above the initial cost. So positive number is good, negative number is bad. So I want to kind of share the formula and kind of talk a little bit about what it's doing. This is the formula that the system advisor model uses to calculate net present value, and to kind of translate this for everyone. Net present value is equal to the after-tax cash flow. And this is something that next week when we're building and running some simulation models, we'll look at the cash flow table. You can dive right into it within the system advisor model, and we'll show you how and where Sam's pulling this after-tax cash flow from, and all of the different things that go into that. But after-tax cash flow divided by 1 plus the nominal discount rate. And remember, nominal discount rate is going to include both the inflation and the real discount rate that you choose for the project, raised to the power of the year. So I know there's a lot of numbers and a lot of things going on this screen, but I think if you bear with me as we walk through it, I think it'll help demonstrate the impact of the impact of the time value of money. So I had a project in SAM that I just put together a simulation for. It's a 50 kilowatt project. And just to kind of give you the background on it, I just used the default installation cost, which was $1.80 per DC watt. I'm sorry, $1.76 per DC watt. In terms of the incentives, we have your standard 30% investment tax credit. We did depreciation on using the maker's model on a 5-year schedule. So these are all things we talked about in Module 4. We applied $18 per SREC, or Solar Renewable Energy Credit, which again is based on generation. We did $13 per kilowatt, so it's a capacity-based cost number for operations and maintenance. $13 per kW annually, and we applied 0.5% of the overall capital investment for insurance annually. So just to kind of give some background on what type of model did we build that we pulled these numbers from, that kind of gives you an idea of what we were dealing with. I didn't include a REAP grant or any state-specific grants. I tried to keep it fairly simple. So this first example, and this is a cash purchase, we're applying a 9% nominal discount rate. So again, that includes 2.5%, I think, is what we had for inflation. and then the real discount rate. So a 9% nominal discount rate. Here are the non-adjusted cash flows, after-tax cash flows from the System Advisor model's cash flow table. And you can see over here, we kind of totaled or summed the non-adjusted cash flows. So if you add all of your annual cash flows up, not adjusted for the time value of money, you're looking at $152,000. So what we do, again, to calculate net present value is we want to apply a discount rate. So we want to recognize that, as an example, let's just pick on year 20 and this $4,560. That $4,560 in year 20 is not worth as much as it would be in year 20 as it would be if I had it today. Okay, so I have that same amount of money. If I had $814 today and I invested it and got a return of 9% compounding over 20 years, I could turn that $814 into $4,560. So what we're doing is applying this formula to our annual cash flows, discounting it over the 25-year life period. We also, just to kind of give as a comparison, we summed our discounted cash flows. And then, as we mentioned, once we discount our cash flows, the net present value is simply the difference between what is the sum of our discounted cash flows. Oops, I skipped a slide. Here, this 80,000. What is this minus our initial investment? So in this instance, at 9%, you can see it was slightly negative. So we had a net present value of negative $7,393. The point I want to make is back to the discount rate being a big impact. So you can see that was at 9%. And I don't want to spend as much time on this slide, but if we run the same simulation, same model, the only difference is we changed our nominal discount rate to 6%. You can see all of a sudden a project that we just looked at and said, well, net present value says it's negative. You probably don't want to do that project. But if we look at that and say, well, at a 6% discount rate, all of a sudden it has a positive net present value. And so that's just kind of back to the point that choosing the proper discount rate is critically important to using and doing a proper assessment on net present value. One of the things that I like to point out is, in general, the more risk that's associated with a project, the higher the discount rate should be. You're going to want to have a greater return for taking that additional risk, right? The other thing to think about as we think about risk is, simply put, the longer the analysis period, the more risky it is. I think most of us could probably, within reason, if we had a project that had a 5-year analysis period, we could, within reason, estimate, what are the conditions over the next 5 years. We could, within reason, look at it and say, okay, based on, current geopolitical conditions, current economic conditions, current inflation rates, state of the economy, value of the dollar, we kind of know what likely outcomes are over the next 4 or 5 years. I think that becomes a much different conversation when you start looking at the next 25 years. So again, when we think about net present value, when we think about the impact of the discount rate, as you have a longer analysis period, you might want to have a little bit larger discount rate to account for that additional risk. To summarize the NPV, again, the strengths, it does account for all cash flows, considers the time value of money. You can rank a project, you can adjust it for different risk factors. The biggest weakness is it is very sensitive to selecting the proper discount rate. And then our final metric that we're going to look at here today is the discounted payback period. Again, the payback period is the time in years that it's going to take for your cumulative annual savings to equal your cumulative annual cost. Now, the only difference between your simple payback period, as Sam calculates it, versus your discounted payback period is we're actually applying that discount factor, and we're discounting our future cash flows back to present value. And so Sam actually uses the same formula that we just looked at with net present value, and applies that to discount future cash flows. And I don't want to pull the formula up again as we just went through that, but knowing that we use that same formula of, after tax cash flows divided by 1 plus our discount rate raised to the power of the year, we're going to discount those future cash flows into present value dollars. And you can see the payback that's non-adjusted in this simulation is 10.5 years. The discounted payback is 19.6. And so, the one thing is we think about discounted payback period is it tells us that break-even point, but it stops short of giving us the rest of the story, which is what net present value does. So, net present value would go on then to sum up these additional years and determine, what is the value of that project above and beyond your initial investment, even after you break even. Now, one of the reasons that that's important, so a weakness of a discounted payback period is it doesn't account for what happens after the break even. And I want to give an example as to why that might be important with solar. Say you have a large system installed on a farm. Say it's a 50 or 100 kilowatt system, and your discounted payback period breaks even in year 14. But then in year 15, you anticipate having to do some type of a major investment in replacing or repairing an inverter. There's going to be a one-time lump sum cost that shows up in your cash flow table that net present value would account for as you look at, what the benefits of the total benefits of the discounted cash flows would be versus your initial investment. Whereas the discounted payback period is not going to catch that initial cost that shows up after we hit our break-even point. So kind of wrapping up, back to our table where we looked at these 4 metrics, and these are the 3 scenarios we used in session number 4 to kind of demonstrate the critical impact of these different incentives. You can see with scenario 1 where we had the 30% investment tax credit, we had our 25% REAP grant, we used bonus depreciation, and we had the value of our renewable energy credits. Again, this is a bit of a review, but this is kind of our best case scenario. Think about our metrics now. So levelized cost of energy, how does this 4.65 cents per kilowatt hour compare to what we're purchasing it from the utility at? Net present value, obviously we can see we're positive. So we're looking at, even after we discount our future cash flows, generating an additional $40,000 above and beyond what our initial costs were. And then as we look at the simple payback period and discounted payback period, 5.6 years and 7.2 years respectively. Now, if we go ahead and start to remove some of those incentives, so in scenario 2, we only have our investment tax credit. You can see now, all of a sudden, we're probably a little bit higher than what we were initially paying for electricity. Our net present value is negative. Simple payback period's 16 years. This NAN for discounted payback period, this simply means that it's longer than the analysis period. So, if you think back to our charts and how we were calculating net present value in the discounted payback period based on those cash flow tables, if you think about anytime your net present value is going to be negative, your discounted payback period is going to be longer than the analysis period, if that makes sense. And then as we look at the last scenario, obviously when you remove your investment tax credit, things get a little bit worse yet. So again, this is hopefully kind of building you from understanding how we design system costs, looking at how we place a value on a unit of energy that we looked at in session 3. Week 4 or session 4, we looked at critical incentives and how they play a role and supporting these projects. And now we're better understanding how we both calculate and apply these metrics. And I think that this should really set us up well for session 6 when we build some simulation models. We can play with some different variables and look at how it's going to impact the performance of our projects. Just a quick link that I want to share. This link here, that sam.nrel.gov, is where you can go to download the system advisor model. I think as we talk about metrics, the takeaway is that simple payback while it can give us initial indication of economic viability, it's not enough information to make a sound decision on. The system advisor model, however, does a good job of giving us additional metrics that once we build the models, it does a lot of the calculations for us, but we looked at some of the formulas behind the scenes to see, why and how it's calculating levelized cost of energy, how it's discounting future cash flows into present value to do a net present value calculation, and then again, how we can recommend using multiple metrics as a means of checks and balances. So with that, that kind of wraps up the discussion on financial metrics. And at this point, I am going to stop sharing my screen, and I believe Evan is going to take over to share his slides. And we're joined by Evan Batchelor and Peggy Hall. And Evan and Peggy are from the OSU Agricultural and Resource Law Program. And they are in the process of developing some resources here in Ohio to help landowners work through the process of understanding the best practices and lessons learned with evaluating solar leases. So Evan, you can go ahead and share your screen.
All right. Trying to find where I can do that real quick. Sorry.
That's okay. While you're doing that, Evan, I'll just introduce the project as you're getting that pulled up. Hi, everyone. I'm Peggy Hall. As Eric said, I am with the OSU Agricultural and Resource Law Program, as is Evan. Do you guys need to talk to each other to get that pulled up? I didn't want to jump in and interrupt you too much. Okay.
I can actually just pull it up for you.
Okay. So we have a grant project we're working on for the National Agricultural Law Center, and it is to develop a solar leasing guide. It will be an Ohio focus guide, but in large part relevant to any state in the country, with the exceptions of some of those specific state laws. So we wanted to tell you about that and also offer some thoughts about how to help landowners who are dealing with that solar leasing process, give you a few points on just what that process will be and some ways that you can advise them through that process in conjunction with getting them to an attorney. So let's start first with Evan sharing the overview of the solar leasing guide that we're developing. Evan?
Thanks, Peggy. So like Peggy mentioned, we've been working a couple months now on trying to figure out how we can help farmers understand kind of the documents that are coming at them, plus all the terms that they're going to see throughout these lease documents, and then some of the other documents that they're going to have to deal with. So real quick, don't want to take too much time on the minutia of the lease legalese, but we want to give an overview kind of what we can talk about here today. So we have kind of the common legal documents, some of the important times that farmland owners are really going to have to think of critically on what is in front of them. I'll explain that more in a second. Some of the particular considerations that you can help them think about, and then also some advice you can give to landowners. So this graph on the right kind of shows basically the life cycle of the lease from when it first takes effect to when the end of the project has naturally completed, or if there's a termination kind of in the middle. So what we're talking about today is pretty much around the effective date and earlier. Okay, so we're talking about getting into the lease. Eric, if you want to go to the next slide, please. So these are the four main documents that we have pretty much seen. They're fairly consistent in that most solar energy developers are using these documents, but what each of them is going to have in each different document is going to vary depending upon the preferences of the solar energy developer. So oftentimes, the first time a landowner is going to hear from a developer that is specifically interested in their land is going to be through something like a letter of intent. So this can be delivered, this can be mailed or emailed, But this is basically kind of the first step in a solar energy developer telling a landowner, I'm interested in looking at your piece of property. But sometimes what these developers are going to do is try to also use the letter of intent to start locking in rights. So really what the focus on each of these documents should be is what they say rather than what they're titled. That's because along with the option, a letter of intent might be used to really start getting landowners locked in like a confidentiality agreement, or it could be already locking in options. So an option is a binding agreement mainly to guarantee the developer the right to develop a parcel. The developer does not have to exercise that option, but the landowner can't enter into any other agreements after the option has been signed and as long as it stays open. But the document will have time limits set out and also explain when notice must be given on whether or not the option is going to be exercised. So the letter of intent and option are two fairly important documents early on that really the landowner just has to read and understand. And if they don't fully understand it, we'll talk about that in a second. But ultimately, the heart of this talking about is the lease. It's the primary agreement that's going to set forth the rights and responsibilities of all the parties involved. These solar leases are commercial leases. The courts are going to expect all the parties to be able to enforce these and are going to expect that they were able to negotiate favorable terms. So they have to be read carefully. You can pretty much think of this as like a 25 or 30-year marriage. Okay. So the last one we have on here is a solar power purchase agreement. This kind of goes along with when the developer wants to sell the power back to the landowner. So I think Eric was talking about this a little bit more, probably has in the past. This is common in like a commercial or industrial context, also municipal context. I'm not sure how often farmland owners go on to purchase the power back from the companies. Eric might be able to speak on that at some point. But those purchase agreements, you'd be looking at just buying the power back, okay? So again, the critical thing here is what the documents say and not what they're titled. So next, unless Peggy has anything, we can go on to the next slide. Okay.
Nope, go ahead, Evan.
All right, so we're calling these critical junctures. Basically, these are like moments of truth, points of no return, okay? So whenever the farmland owner gets a writing that requests a signature and offers money, this is where the farmland owner is going to be locked into an agreement, okay? Often this could be for the first couple documents, like the letter of intent and the option, these are going to have the confidentiality clauses and the option to lease. But for the actual lease, once that document is signed, you're in it for the long haul. So these are the points in time where the farmland owner wants to make sure that he or she really understands what they're signing before they actually sign it. And that's because if we go on to the next slide, there's a lot of things that will be covered in these documents, okay? So especially in the lease, as you can see, this is a long list of things that farmers need to understand what the implications are. So when we talk about being long-term, as Eric said, this is a potentially up to 30, 35-year agreement where the solar energy developer is probably going to be using this piece of land exclusively. Hey, I'll go ahead and let you talk a little bit about some of these. You had a good summary of them.
Oh, well, it's hard to summarize, and this actually isn't a complete list of all of the issues that a landowner would need to think about. I think it's interesting to separate the process here a little bit for those of us who would be helping landowners through this. We've got the overall process of solar leasing, But then we have the issue when it comes particularly to farmers in thinking about the impacts that lease or that change would have on the farm business and the agricultural land itself. And so when we get into the lease, that's where we really need to work through those kinds of issues. What will it mean for the farm business, and also for that land and managing that land, and the loss of that production, and the long-term issues that you see here, like maintenance and cleanup. Those are all issues that are particularly unique to the agricultural landowners. And so in the guide, we go through all these different areas of concern and point out how the language in the lease that may or may not exist could affect the producer from that standpoint. So I don't want to go into too much detail, but just to let you know that there is a lot there that a landowner needs to work through, and thinking again about, how does this affect the overall farm and the land itself. So that will all be included in the leasing guide.
Yeah.
So, Eric, we can go on to the next one and talk a little bit about how to help landowners through this process. So, Evan?
Yeah, so our understanding was that most of the people on this call are like extension professionals who are going to be fielding questions from farm owners and landowners that really are trying to investigate this process and trying to figure out what's going on. So we had a few tips that we thought that would be good kind of references for you to understand how you can really help them along this path. So first of all, the first piece of advice that you can give them is to read all the documents very carefully. We talked about how there's a lot of different terms in them and there can be a lot of legalese. So see if they can try to understand and work through it. Next, Peggy and I talked a little bit about the Farmland Owner's Guide that we've been developing that tries to boil down all of these terms and all the documents and the process and the things to consider. But then also just researching the solar developer. This is something that when Peggy and I were talking with Eric about this project, he suggested this is a good point to help farmland owners figure out, am I getting into a good relationship, or there are already warning signs and red flags out there. So then after they've done all this, they need to reread the documents to figure out if their initial understanding was kind of correct and if they're reading anything else. But lastly, consulting with an attorney that either has solar leasing or ag law experience is very helpful. Usually it may not take more than a couple hours of their time, depending upon the comfort level of the farmland owner and the attorney. This is kind of like a checkpoint where the farmland owner can really understand whether or not I'm getting a good deal and whether or not I really understand what the terms of this relationship are. So that's a very important thing that we would advise people to do, but that's ultimately up to the farmland owner. So we can go on to the next slide. This is the guide we've been talking about. It's basically a start to finish walkthrough of questions to ask and all the things, or at least most of the things, that a farmland should know before they sign in a lease or even some of those earlier documents. This document's are geared toward Ohio farmland owners, but aside from the first chapter, all these numbers in red, the common legal documents, the lease and legalese, and we have also a checklist. These really can be adapted to just about any state. And that was partly our intent, but also because some of these lease documents are just general enough in terms of legal enforcement that any state could really use this guide in a helpful way. So, and then I think we're on to our last slide. We have our website listed here and our email address if anyone has any questions. Hopefully we'll have this project wrapped up in the next month or so and posted where everyone can view it and refer to it. So, there are any questions, or Peggy has any comments?
Well, I just want to point out, as I said before, this is a National Agricultural Library grant from USDA that we are doing in partnership with the National Agricultural Law Center, and the guide will be posted on their website as well and available to anyone. I also wanted to point out, we had a conversation this morning with some of our extension educators from around the state of Ohio, and I was a little alarmed when one of them said that some of the landowners in her area were receiving these very short leases, just a few pages, and that's not a good sign. If you have landowners who just get a 1 or 2 page leasing type document, please do encourage them to have that reviewed. That surely would not be sufficient to address all of the issues that could impact farming operations. So a little bit of concern there. We also heard that with the way things are going here in Ohio, at least with planting or the lack of planting, that some of these leases are looking pretty desirable. And so there may be a little bit of anxiety on the part of our landowners and willing to go ahead and sign and get that cash influx. So another concern to be aware of. And with that, Eric, any questions we can answer for anyone?
Well, and I think just one closing statement, and we'll just open up the lines for questions. This our project is funded through a SARE grant, and so we have roughly 75, I believe, registered for the webinar series. Kind of a mixture of extension personnel and USDA rural development and NRCS staff. So once that document's done, we'll certainly circulate it to the email list of all those who've registered, so they have it as a resource. And I guess, John, with that, we can go ahead and take questions through the chat box, or if you would like to unmute yourself, if you have a question for anything related to the financial metrics that we discussed or leasing, feel free to pose those questions now. And I'm going to go ahead and put the poll up.
That was excellent, Eric. Thank you, everyone, and thank you to Evan and Peggy. That was a great addition. I think that's really good advice, and I think you did distill it down to some really important pieces of advice to give. And I'm looking forward to seeing your document and maybe even utilizing it as a resource for some of the stuff we do here in Nebraska. We could probably go ahead and end the recording, Eric, and take as many questions. I don't see any questions come in on the chat right now, but I just want to thank everyone